Understanding the bear put spread, a bear put spread, also known as a debit put spread or long put spread, is an option strategy used when you have a moderately bearish outlook on an underlying asset, in this case, a cryptocurrency or a crypto futures contract. You expect the price to decline, but not drastically, and you want to limit both your potential profit and your potential loss. How it works: you simultaneously 1. Buy a put option with a higher strike price. This is your long put. 2. Sell a put option with a lower strike price. This is your short put. Both puts must have the same underlying asset and the same expiration date. The logic: buying the higher strike put profits as the price of the underlying asset falls. Selling the lower strike put helps to offset the cost of buying the higher strike put and limits your maximum profit if the price drops significantly below the lower strike. Key characteristics: Net debit. You pay a net premium to enter this trade, as the higher strike put you buy will generally be more expensive than the lower strike put you sell. This net debit is your maximum potential loss. Limited profit. Your profit is capped at the difference between the two strike prices minus the net premium you paid. Limited loss. Your maximum loss is limited to the net premium paid. Why use it for minimum profit? The phrase minimum profit usually implies you want to achieve any profit, even if small, or that you're aiming for the maximum possible profit within this strategy's defined limits. The bear put spread is about limiting risk while still participating in a downward move. It's not designed for unlimited profit potential, but rather for a defined, calculated profit when you anticipate a moderate price drop. Scenario for minimum profit. To achieve any profit, the price of the underlying crypto must fall below your break-even point. The maximum profit for this strategy is realized if the price falls to or below the strike price of your short put at expiration. Calculating key metrics: net debit, maximum loss, premium paid for long put, premium received for short put, maximum profit, higher strike price, lower strike price, net debit, break-even point, higher strike price, net debit. Step-by-step process for a bear put spread in crypto options. US. Step 1. Market analysis and selection of underlying asset 1. Identify a cryptocurrency or crypto futures contract with a bearish outlook. Look for a crypto asset that you believe will experience a moderate price decline in the near to medium term. This could be due to O. Technical analysis indicating a downtrend. O. Fundamental news or events that could negatively impact the crypto's price, e.g. Q, regulatory concerns, project setbacks, broader market sentiment. O. Macroeconomic factors impacting the crypto market. 2. Choose a regulated exchange. Select a U.S. regulated cryptocurrency options exchange that offers options on the chosen crypto's futures, e.g., CME Group for Bitcoin, Ether futures options, or other platforms that offer compliant crypto derivatives. Ensure they support European-style options if you're trading CME futures options, as these are common. Step 2. Strategy construction. Selecting strike prices and expiration. 1. Determine expiration date. Choose an expiration date that aligns with your bearish outlook. If you expect a short-term drop, a closer expiration might be suitable. For a more gradual decline, a further out expiration might be better. 2. Select strike prices. O. Buy the higher strike put, long put. This option should ideally be at the money, ATM, or slightly in the money, ITM. This put will give you exposure to the downside. O. Sell the lower strike. Put, short put. This option should be out of the money, OTM. The premium received from selling this put will partially offset the cost of your long put and define your maximum profit and loss. The further OTM this strike is, the smaller the premium received, but the larger your potential maximum profit, if the price falls below it. However, it also means the underlying needs to fall more to reach that maximum profit. 3. Consider the spread width. the difference between the higher and lower strike prices. This directly impacts your maximum profit and maximum loss. A wider spread means higher potential profit, but also a higher net debit, and thus higher maximum loss and loss. Example: let's say Bitcoin, BTC, futures are trading OS at $60,000. You are moderately bearish and expect it to drop to around $55,000. Buy 1 BTC. Put option with a strike price of $58,000, higher strike, for a premium of $3,000. Sell 1 BTC. Put option with a strike price of $55,000, lower strike, for a premium of $1,000. Both options have the same expiration date, e.g., 1 month out. Step 3. Calculating costs and profits through loss potential. 1. Calculate net debit. O. Premium paid for long put. $58,000 strike. $3,000 premium received for short put. $55,000 strike. $1,000 or net debit is $3,000. 1 DC is 2 dis. This is your maximum loss. 2. Calculate maximum profit. O difference in strike prices equal $58,000, $55,000, $3,000, under maximum profit equals $3,000. Difference in strikes, $2,000. Net debit, equals 1,000 O's. This maximum profit is achieved if BTC futures are at or below 55,000 at expiration. 3. Calculate break-even point. O break-even point equal higher strike price. Net debit O break-even point or 58,000. 2,000 equals $56,000 O. You start making a profit if BTC futures fall below $56,000 at expiration. Step 4. Executing the trade. 1. Place a multi-leg order or spread order. Most options trading platforms allow you to place both legs of the spread simultaneously as a single order. This ensures you execute both the buy and sell at the desired net debit. 2. Monitor the trade. Keep a close eye on the price of the underlying crypto futures contract and the time decay of your options. 3. Manage your position. O, if the price falls as expected, towards or below your short put strike, you can let the trade expire to realize your maximum profit, or close it early to lock in profits. O, if the price stays above your long put strike or rises, both options may expire worthless, and you will incur your maximum loss, the net debit. O, if the price is between the strikes, your long put will be in the money, and your short put will be out of the money. You might still make a profit, but less than the maximum. Tips for maximizing minimum profit, or achieving any profit. Accurate bearish outlook. The strategy relies on your prediction of a moderate price decline. Thorough technical and fundamental analysis is key. Optimal strike selection. O. Choosing a long put strike that is slightly out of the money, OTM, or at the money, ATM, might reduce your initial debit and thus your maximum loss, potentially making it easier to break even or achieve a small profit with a smaller move. O. The closer the short put strike is to the long put strike, the smaller the maximum profit, but also potentially a smaller initial debit. Volatility. A bear put spread benefits from increasing implied volatility after you initiate the trade, as it will generally increase the value of your long put more than your short put. However, entering when volatility is high means higher premiums initially. Q. Time decay, theta. Time decay generally works against the long put option. However, in a bear put spread, the short put's time decay can partially offset the long put's time decay. If the price moves favorably and gets closer to the short put strike, time decay can start to work for the spread. D. Early exit. Don't feel obligated to hold until expiration. If you achieve a substantial portion of your potential profit before expiration, consider closing the spread to lock in gains and avoid the uncertainty of expiration. Commissions/fees factor in trading commissions and fees, as these will reduce your net profit. Risks to consider: limited profit potential. Unlike simply buying a put, your profit is capped. Market reversal. If the crypto price unexpectedly rises, you could incur your maximum loss. Not liquidity. Ensure there's sufficient liquidity in the options contracts you choose, especially for crypto options, to avoid wide bid-ask spreads that can eat into your profits. Regulation. The crypto regulatory landscape in the US is evolving. Stay informed about any changes that might affect options trading. Assignment risk for the short put. While less common with European-style options on futures, which typically settle to futures contracts, if you are assigned on your short put, you would be obligated to take action on the underlying futures contract. Remember, options trading involves significant risk, and it's essential to fully understand the mechanics before entering any trade. Consider starting with a paper trading account to practice if you're new to options strategies. Please like, subscribe, and comment.